The Yield Max Tesla Option Income ETF, known as ticker symbol TSLY, has sort of been in some hot water as of recently throughout the community. And this is because as times went on, a lot of investors aren't necessarily super thrilled about the overall total return performance of this ETF. Now, it's definitely, of course, not the fact that this ETF pays a small dividend by any means. This ETF has been paying massive dividends since the inception. But unfortunately, a lot like many of the other covered call ETFs that offer a super high yield, this ETF might be no different and has been decaying like crazy. Now in this video, we're going to dig a little bit deeper into TSLY and why for me personally, I've still been buying shares of it like crazy over the past few weeks. Then later, we're going to look into Tesla, TSLY, compare the two's performance. And then lastly, I'm going to show you a secret method that many people don't know on how I hedge against the worst part about this ETF at all, the price decay. Now, if this interests you at all, stick around, drop a like down below, and let's get right into it. Before we get into today's video, make sure to please go to the first link in my description and grab my brand new dividend investing ebook and dividend tracker bundle. I promise you guys are going to find tons of value in both. So first, real quick, for those that might not know, TSLY is a covered call ETF. Basically, YieldMax uses a synthetic covered call strategy and basically tracks the underlying Tesla stock, sells covered calls, and earns a ton of premium for doing so. So first, just a quick little background on the TSLY YieldMax Option Income ETF, just the basics though, because we've talked about this ETF so many times on the channel, and if you happen to be interested in that, go back and watch some of my previous videos. So right here directly on the website from YieldMax, it says the fund does not invest directly into Tesla, which is the underlying stock that TSLY basically tracks or references to. It also says investing in the fund involves a high degree of risk because it uses a synthetic covered call strategy. Also important, it says the fund strategy will cap potential gains if Tesla share increases in value. But also importantly, this fund strategy is subject to all potential losses if Tesla shares decrease in value. And as you can see here, because of the massive premium, the distributions on a monthly basis have been huge. The most recent distribution was over 60 cents, and that's on a monthly basis from an ETF that costs around 12 bucks. But like we talked about earlier, this ETF has seen some massive decay, which means that for investors even earning these massive dividends, a lot of investors are actually running their position, believe it or not. So first, comparing TSLY to Tesla. This is what a lot of investors like to do. So year-to-date performance, Tesla is up 132%. Now, of course, Tesla does not pay a dividend. These are just all off of the price gains, of course, the price return. And although TSLY isn't up as much as Tesla year-to-date, TSLY so far is up 55.99%. Year-to-date if we look at the price return or lack thereof, and if we include all those massive juicy dividends. Most critics say the exact same thing. For those investors that want to invest into TSLY to have some exposure to Tesla, they would have been much better off just buying shares of Tesla, considering you would have made double the return year-to-date if you would have just bought the stock. Keep in mind one certain thing. When investing into a covered call ETF, especially like this one, TSLY, you're most likely going to see the ETF decay in price over time. Now, this is because a covered call ETF does have a capped amount of upside. Now, since TSLY references to Tesla stock, if Tesla stock has a crazy green day, moves up in price, TSLY is going to be able to follow it by a degree and have some of the upside captured, but it's going to have a limited upside because, again, the covered call mechanics, which I went over in previous videos, so again, make sure to take a look. But now on the other hand, if Tesla, once again, the stock that TSLY references to, decreases in value quite a bit, let's say on a daily basis, which can happen with a high beta stock like Tesla, well then of course TSLY is going to lose some of its value. And although the cover call is going to make up for some of the loss, it doesn't have necessarily a capped downside. So that's exactly one of the reasons on why cover call ETFs can be risky at times, and just know how they work. But just wait 1 second, not all hope is lost. I've been using a pretty interesting strategy in order to buy shares of YieldMax TSLY ETF, get that massive juicy dividend on a monthly basis, and protect against my downside, because as we know, TSLY has been known to decay. Now what I'm talking about doing here is selling cover calls on TSLY. So try to follow along with me right here, for example. So TSLY is currently trading at $11.69 per share. So one of the main goals that we have when it comes to TSLY, or I should say one of the main goals that I personally have when it comes to buying TSLY is what? It's to earn a ton of cash flow on a monthly basis from that juicy dividend. But like we said earlier, the dividend maybe means nothing if the price is just going to continue to decay and make our initial investment worthless. But hear me out, follow along with me. So if TSLY is currently at $11.69 per share, what I would do, or what I have been doing, is going into the money a little bit. Let's say a $10 strike price and sell a cover call for $1.70 or $170 a premium. Now what this basically means is that from now up until August 16th, 2024, which is 246 days away, and keep in mind you could of course use whichever expiration date you think of. But from now until then, I'd be willing to sell my 100 shares of TSLY for just $10 per share, because right off the bat, I'm earning $1.70 in premium for basically selling this call to the call buyer. Now, what does this do? Now, what's the point of this and what does this do? Because TSLY has shown, at least so far basically, that this ETF is going to continue to decay over time, I personally think that there's a good chance that TSLY could be trading at $11 per share in the next month or two, or even maybe under that, maybe at $10 per share. So because I think that, I'm basically indirectly shorting TSLY while also holding onto the shares of it. So what I'm doing is very simple. I'm earning this massive premium and basically offsetting the possibility of the decay in the future. All most importantly, month by month, earning that massive dividend along the way. So by utilizing a super high yielding cover call ETF like TSLY, I mean, you can do this with anything. You can do this with any cover call ETF out there for the most part. You're basically capping your upside, saying that if TSLY, for example, does rocket up in price, I might have to sell my shares and basically break even on what I paid for them. Because remember, you bought them for $11.70 per share, and you're willing to sell them for $10 per share, but you earned $1.70 a premium per share. So it's basically break even. If the shares get called away in the future, if TSLY moves up, your shares are gone and you're basically back to where you started. But if TSLY trades sideways or even down a little bit, which pretty much for the most part is what it has done so far, within most time frames, well then in that case you would be doing exactly what I've been doing. Buying shares of TSLY, selling cover calls on the shares, earning the massive dividend along the way, and also capping your downside, which is awesome. Now an actual example that I did of this, I bought TSLY a while back when it was $14 per share or something like that. I then sold a cover call for around $2 per share, so $200, and now that TSLY is trading under $12 per share, the call that I sold is basically worthless. Or as you can see right here, it's worth around 10 cents. So what I could do now, of course, is I could even drop down and sell another call and just basically continue to short this thing all the way down to the bottom. Well, once again, most importantly, say it with me, earn the massive dividend along the way. Now, as more of a dividend income focused investor, to me personally, this sounds like the perfect best of both worlds. Because once again, you're buying into an ETF that offers a massive dividend yield. The trailing 12-month dividend yield for TSLY is like 70 or 80%. Yes, I know it's insane. But by shorting it or selling cover calls along the way, what you're doing is protecting your downside. So if and only if it continues to decay, you are not going to be sad that your initial investment is decaying to zero. So for me personally, I'm going to continue to stack up as many shares of TSLY as I possibly can, just on the side. And for every 100 shares of TSLY I get, I'm going to be selling cover calls on them to protect my downside, but also to retain my shares and earn that juicy dividend month after month after month. So now that we went over TSLY, talked a little bit about the performance of the ETF, compared it to Tesla even, and talked about my strategy on what I've been doing when it comes to TSLY, selling cover calls on it, which, correct me if I'm wrong, but I have not really heard anyone else doing this. And I personally think it's a very good idea for those investors out there that want to protect their capital, but also want to get in on the action. I want to hear what you guys think down below of all this. Are you personally still buying TSLY currently? And comment down below what you think about my strategy of selling cover calls on your shares. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.